Welcome to 116A. This is the beginning of your accounting journey. This whole semester just goes over basic accounting, and if it turns out you really like it, then you probably want to take Intermediate 2, which goes into more depth on all of accounting. Now, my suggestions to you is to, whenever you're looking at a chapter, particularly the first three, do the SMART books first because they give you an overview of the chapter. Before you start the homework, you can also do the practices that are the same as the brief exercises in your book. These are set up to give you immediate feedback but are not worth any points. When you start the homework for each assignment, if you need help, you can go to the bottom of the page and they'll have something called hints. And if you select that, they'll walk you through a similar problem. And finally, if you need some help, I'm here too. All you have to do is email me. Now first, there are actually two types of accounting. There's financial accounting, which is what we cover in this book. This focuses on outside users of financial information and must comply with generally accepted accounting principles called GAAP. Then there's managerial accounting, which you cover in 116B, actually my favorite class, which focuses on internal users and does not have to comply with GAAP. Such things like budgeting, that would be included in managerial accounting. Now, financial accounting is a system that identifies, records, and communicates financial information that is relevant, reliable, and comparable about an organization's business activities. Now, there's the FASB, which is the Financial Accounting Standards Board, and they're primarily responsible for the establishment of standards of financial accounting and reporting called GAAP. U.S. Generally Accepted Accounting Principles is overseen by the Securities and Exchange Commission, and sometimes they take an active role, sometimes they don't. There also is another standard called the International Standard. Just so you know, GAAP does not apply for all countries. It only applies to the United States and a few other countries, but most other countries go under the International Standard. There was a time when we were supposed to merge, but we're too rule-based, they're principle-based, and we love our rules. So, and also our financials are used for different purposes than theirs. So, we have not merged and we never will. Now, accounting concepts. Now, revenue recognition principle. These are some basic principles that are very important that you understand. So, revenue recognition principle says revenue must be recognized when it's earned. So what that means is it's not necessarily tied to the cash. An example would be you perform services for someone. That's revenue even if they haven't paid you. You sign a contract with someone and they give you an upfront payment. That is not revenue under GAAP because it hasn't been earned. Historical cost principle. We record financial transactions based on what we paid for them. Now, we have slowly been getting away from this, and it started with how we value investments. And the reason for this is it used to be what companies would do if they made a bad investment. They would just keep it on their books at what they paid for it, and it could have lost almost all its value. So they came out with rules, the fair value rule. It's called the fair value rule, and what it said is that investments need to be carried at fair value, i.e. at the end of each year, you need to assess the value of your investments. Now, in other countries, they also do this for equipment, but we don't necessarily do that. Going concern. It assumes that the business will continue into the future. Monetary unit assumption. All we care about is monetary transactions. What that means is if they involve money, we have to keep track of it. Full disclosure. The rule is that financial statements will reflect all information important to an informed user. Now what that means is it's not for everybody, it's for people that understand financial statements. Expense recognition or matching principle. We record expenses when they are consumed. Again, the issue here is if we buy a piece of equipment and we're going to use it for 3 years, we would not consume it when we bought it, so therefore we would not treat it as an expense, but we would over the 3 years as we use it, and we'll talk about that later. Time period assumption. Accounting can be broken down into months and years or arbitrary periods. And business entity principle. We only include financial transactions associated with the business, not personal or other companies. Now we'll go through some examples. Now, a business will continue into the future. That is the definition of a going concern. Indicates that personal and business record keeping should be separately maintained. That is the definition of the economic entity. Assume that the dollar is the measuring stick used to report on financial performance. Monetary unit assumption. Maintains that each organization or section of an organization stands apart from other organizations and individuals. That's the economic entity principle. The principle that assumes transaction and events can be expressed in monetary unit. That's the monetary unit assumption. Reporting must be done at defined time intervals. That is periodicity. Now let's look at some more. These are actually good definitions for you that you understand. All right, now accounting information is based on actual costs. That's the cost principle. Record the expenses incurred to generate the revenue reported. That is the expense recognition or matching principle. Revenue is recorded when a financial transaction is completed. That is the revenue recognition principle. Allocate expenses to revenue in the proper period. That's the expense recognition. Enables accountants to ignore the effects of inflation in the accounting records. That's the cost principle, but again, that has slowly been changing in accounting. We're starting to look more toward fair value so that the books actually do reflect the real value of the company. Because let's face it, if you bought a building for, say, $1 million, but now because of what's gone on around, that same building is worth $20 million. Don't you think that would be a better reflection of what value you have? So those are the issues that we deal with in accounting. Now, a company must report all information that would affect an informed user of financials. That's the full disclosure principle. Now, role of accounting in a business. Again, we recognize, measure, and record, and then we report. Business transactions. Now, most people are familiar with cash. That's how we keep our own information. Transaction is recognized when cash is received or dispersed. But under general accepted accounting principle, a transaction is recognized when it occurs, whether or not cash is received or dispersed. Accounting formula. This is something you need to memorize. First, you need to know the definition of what is in the accounting formula. So, one of the first categories we have is assets. These are resources of the company that have future economic value. An example might be cash or equipment. Liabilities, creditors' claims to resources, accounts or notes payable. Stockholders' equity, owners' claims to resources. An example would be common stock. So, this is the accounting formula. On the books, the assets that you record, which are resources, have to equal the liabilities plus stockholders' equity. That's the accounting formula, which must. Again, always be in balance. Through this whole process, when you do journal entries, you need to make sure that whatever you do, assets equal liabilities plus equity. Some more accounting terms. Revenue. are the amounts recognized when the company sells products or provides services to customers. Expenses are the costs of providing products and services and other business activities during the period. Net income is the difference between revenue and expenses. Other common names for net income include earnings or profit. Dividends are distribution to stockholders, usually in the form of cash. Dividends are never, ever, ever an expense. Make sure you remember that, because that's a mistake many students make. So let's take a look at what we've learned so far. We have the accounting formula, right? Activities related to resources of the company, those are assets. Amounts owed are liabilities. Stockholders' investment or stockholders' equity, and that equals the accounting equation of assets equal liabilities plus stockholders' equity. Distribution to stockholders, dividends. Sales of products and less the cost of providing those products equals net income. Now let's expand our accounting formula. We said we have assets equal liabilities plus equity. However, equity is defined as contributed capital minus dividends plus revenue minus expense. Now, retained earnings is revenues minus expenses minus dividends. That's a separate category. Now let's go through a little example. All right, supplies, what type of account is it? Well, supplies, since it has future economic value, you can use it, get a benefit from it in the future, would be an asset. Notes receivable, somebody owes you money, that's an asset. Service revenue, that's revenue. Dividends, that is equity, stockholders' equity. It reduces stockholders' equity because you're paying out. Accounts payable is a liability. Cost of goods sold. Remember, cost of goods sold is an expense. Whenever you sell goods, when you buy them, they're inventory. When you sell them, they go to cost of goods sold. Capital stock is part of equity. Accounts receivable is an asset. Equipment is an asset. Notes payable is a liability. Now let's take a look at some examples of the accounting formula. This is like your homework. Company A has total assets of $228 million, liabilities of $107. What is stockholders' equity? I always say, do the formula, guys. So, assets equal liability plus stockholders' equity. So I plugged in the numbers, and then I move the 107 to the other side of the formula, which means I have to subtract it, which tells us the stockholders' equity is 121. Then you check by putting in the formula, and it is correct. Now let's look at another example. Company's stockholders' equity went up 20,000. If they issued stock of 20, had net income of 12, how much were the dividends? So again, we'd put them in this other formula, which is stockholders' equity equals common stock minus dividends plus net income. Now we have net income as long as our revenue exceeds our expenses. If our expenses exceed our revenue, we'd have a net loss. So we put them in the formula. Then we move things to the other side of the formula, and we get 12,000. So now we put it in our solution, and we get the correct answer. So that concludes part 1 of this presentation for Chapter 1.